Hello traders, you are welcome back to the Forex Geek channel. Have you ever wondered how institutional traders move the markets? Why do price spikes happen right before major reversals? Have you thought about that before? Well, the answer lies in ICT, institutional order flow trading. It's actually a method that is used by professional traders to follow the smart money instead of fighting it. So if you want to trade like the banks, then this is the video for you. Okay, welcome back to the channel once again. And if you're serious about improving your trading skills, make sure to like this video and subscribe to the channel for more high level trading content. In this video, we are going to be breaking down the ICT, institutional order flow trading. And of course, it's one of the most powerful concepts for understanding market structure and liquidity. So let's just quickly get started. All right, to put it simply, yeah, institutional order flow is the movement of price based on large financial institutions, hedge funds, and market makers. So these players control massive capital and use liquidity zones. They control massive capital and use liquidity zones, you know, liquidity zones, stop horns, order blocks to move the market in their favor. All right? Well, it might sound quite unfair, but I guess it is what it is, right? While retail traders rely on indicators, institutions use raw price action and liquidity manipulation to execute trades. So now, retail traders often fall into the same trap. They place stop losses in obvious places. For example, now, if you had entered a sell around here, if I am to ask you, if you enter a sell, because you can see there is a resistance here, right? So if you were to enter a sell around here, where would you set your stop loss? Can you see that we have a particular resistance zone around here? Can you see that? So it seems as if we had a sort of a false breakout. It seems as if we had can you see, it seems like we had a sort of a false breakout around this zone, right? If you were to enter a sell around here, likely your stop loss might have fallen within this zone because you would not want to risk too much, right? But look at what happened. Price went above this immediate resistance, and whatever it did around here, and before you know it, it fell down back massively massively to this point. So in this case, you would have gotten stopped out if your stop loss was tight. It was a stop hunt probably, because you would have gotten stopped out. So that is the reason why it is advised, for the sake of not falling victim of these institutional traders that manipulate price, not falling victim of stop hunts and liquidity sweeps. You should give some pips away from resistance. If you're setting a stop loss for your sell order, you should give some pips away from support if you're setting a stop loss for your buy order. All right. So, apart from the fact that retail traders place their stop losses in obvious places, which these big guys can take advantage of, they also chase breakouts. For example, now, if this false breakout had made you to jump in to enter a buy, before you know it, price will reverse and you'll be in a massive loss. Or, well, if you had set stop loss, you would have closed that trade in a loss, right? So sometimes do not be in a haste to jump into a breakout trade. That's the reason why it is good that you always have a confirmation. If a breakout seems to happen, wait for a retest, and not just that, wait for a continuation before you enter the breakout trade. If you don't have a retest and a continuation confirmation, please stay away from that trade. Okay, institutions exploit this behavior by liquidity grabs, where price is pushed to sweep liquidity before reversing. Also by order blocks, large buy or sell zones where institutions place massive trades, and then displacement. Sometimes aggressive price moves that signal institutional involvement, and then also inducement, which are fake breakouts designed to trap retail traders. So to trade like institutions, you need to understand these key ICT concepts. You need to understand order blocks. There are areas where large positions are placed, acting as key support and resistance. And then you need to understand liquidity pools. There are areas where retail traders place stop losses, like this example we just identified, and it's often targeted before price reverses. I need to understand fair value gaps. There are imbalances in price action that institutions tend to feel. All right. And then you need to understand displacement. There are sharp moves in price that indicate institutional involvement. So by understanding these core principles, you can align your trades with institutional movements instead of getting caught in market traps. So now that you understand what institutional order flow is, how can you actually use it in your trading? Here is a simple step-by-step approach, okay? The first step is to identify liquidity zones where retail traders have placed their stop losses. Once you have identified that, you wait for a liquidity grab. What does that mean? You wait for a sudden spike, right? Wait for a false breakout to happen. Do not be in the haste to trade a breakout, okay? You wait for a sudden spike that clears those stop losses. So if traders had set maybe a stop loss around here, you wait for a false breakout to happen, let their stop losses be triggered, and then let a reversal happen. All right? You look for other blocks and fair value gaps. You look for maybe, let's see if we can find such an example here for a fair value gap where an imbalance needed to be filled. Okay, we didn't exactly have such, around this particular zone, right? So let me see if we can have another example. Okay, all right, let's just see. Sometimes you need to be, pay close attention to spot some of these things. All right, just for the sake of time, in order not to waste so much time, basically, whenever a breakout happens, just be careful to watch closely, because it could be the market makers at play. Okay, it's not as if every time that a breakout happens that a reversal is going to happen. No, there are actually real breakouts. Okay, but just to be cautious, whenever a breakout happens, just pay attention in case of if there's going to be a liquidity grab, in case of if there's going to be a reversal, as a result of market makers. So watch out for any sudden spikes you see happening around breakout points. Watch out for any sudden spikes, and then watch out for any fair value gap. In this particular example, I couldn't exactly find a fair value gap, which is a situation whereby maybe you see a very large candle, like let's just use an example. Okay, for that purpose, let me just add this so that we can use that as an example. Okay, sorry, I think I added the wrong indicator. All right. I just want you to understand the concept. Okay, so now you have to be looking out for a situation whereby there is a long candle. All right, a long candle that the previous candle's low and the next candle's high, if it's a sell candle, they couldn't fill up the space in between. Can you see? This candle was so long that this low and this high are far from each other. So if you notice such a thing around a breakout point, you should be careful, because it might be market makers at play. All right, so I just want you to understand the concept. So once you look out for these things, then you enter a trade when price reacts to an order block with strong confirmation. Then you set your target at the next liquidity zone. So after you notice a reversal happening, if actually it is institutional players at work, there might be a reversal shortly afterwards, and then after the reversal has been confirmed, you can enter your trade. So in that case, you will not fall a victim of that liquidity sweep that would have happened. So you wait for all this to happen, then you enter trade in the opposite direction, which is the real direction. All right, you set your target at the next liquidity zone. Perhaps you know, you look for if you had entered a sell, perhaps you can set your target around here, right? Your profit target perhaps can be around this zone. Okay, so that is how you can, you know, trade using the ICT, institutional order flow. Now you understand how institutions move the markets and how you can follow the smart money instead of fighting it. So if you found this video helpful, hit that like button, subscribe to the channel, and turn on notifications so that you do not miss out on more future trading tips. All right, have you used ICT trading concepts before? Let us discuss in the comments. Turn on notifications, okay? Do not forget about that. See you in the next video. Happy trading.